right, good morning. So I will cover essentially 4 key metrics, and I believe there's a clicker up here. There we go. Cover 4 key metrics that you could probably use to look at a SaaS company and figure out profitability and then valuation from that. The 4 metrics get into customer lifetime value, and I'll describe why behind all of these, retention rate, revenue acquisition, and gross margin. First, a little bit about Scout. We were founded under a notion of providing predictive analytics and a layer of automation so that you could maximize customer lifetime value. And it's really thinking at each stage in the customer life cycle, how do you engage that customer with the right play and the right interaction, essentially to grow your revenues, to make sure you've cut your churn rate and grow profitability. So that's the quick about Scout. There's a lot of talk about subscriptions. You know, like subscriptions are new. Subscriptions have been around for a long time, so it's not a new business model. And I don't know how many people belong to Columbia House Records. I certainly did. I signed up and I got my subscription, right? I could get a certain number. We've had newspapers, magazines, all kinds of things have been under subscription. The information industry does $180 billion a year in subscriptions, right? They've been around for a long time. They ship books onto library shelves for a long time. So subscriptions are not new. Right? So then what's so new about all this stuff? That was the supply chain economy. The consumption economy is completely different, right? So when you think about Spotify, right, I have a subscription to a music service. I have 2 music services here. When my subscription with Spotify ends, guess what? I don't have a music library anymore. But with Columbia House Records, I've still got all my CDs. I can still listen to them. I can rip them onto my MP3 or whatever I'm going to be using, right? So it was a different business model altogether, and that's fundamentally what's changed. A couple of things have changed about it. So we talked about the first is that it's time-bound. When that timer's over, I no longer have the product. It's over, right? So the product or the service, however you want to call that, is now gone. So that's the first thing that changed. And so it means that somebody is buying into a period of time, right? So there you have it. They have a window of time of which they can get value, and the question is, are they going to get value during that period of time? The second is there's no transfer of ownership. As I just talked about, when the timer's over, I don't have it anymore. The other one, I could still share it with my friends. I might, if I'm doing Dollar Shave Club, right, I might still have a bunch of razors that I give out as gifts because I no longer have it. I could actually have old inventory, so I could use it up when I'm done. So I can get my value out of the product, even though my subscription ended, because I didn't have to get all the value during the term of the subscription. And that's this issue of no transfer of ownership. So that's the second big issue. The next is it's a shared asset model. So when you think about your infrastructure, you've got to start thinking about the whole gross margin. And how do you get the most efficient utilization out of everything that you've got in there? Because ultimately, that's going to be what defines your own cost structure and your own ability to compete. If your asset utilization is 1% less than your competition, in other words, you've got 1% higher gross margin, they can take that percentage point and invest it into new product, and you can't, right? So the shared asset model and getting really good about shared assets is critical. So even in the case of Spotify, what's the shared asset? Well, they went out and they licensed a music library, right? So they've got this huge music library that they now have as an asset, and they've got to figure out how to get maximum utilization out of that. And the final thing is that the upfront cost, right, that sunk cost to get in, as we all know, is lower. So there's a reduced influence on that sunk cost. And matter of fact, vendors are getting really smart about how to convert you from one to another. I can convert your music library for you. I can convert your customer information for you. I can convert your processes. Those are getting easier and easier to do. So the barrier for movement is definitely a lot lower. So that's what's totally different about this model. What it means now is customers are no longer purchasing to own, but they're purchasing to use. They're buying usage. That's exactly what it's consumption that they're interested in. And it's consumption as to how they get value. So whether it's Spotify, a data center with Amazon, Salesforce, Car2Go, so I'm sure everybody's familiar with that, ability to pay, 37 cents a mile, maybe it's gone up, or 37 cents a minute, whatever it's up to now. That ability to do that. You can actually do it on women's professional clothing. You can have 10 suits that you can use at any one point in time. When you want a new suit, you send it back in, and that keeps your wardrobe moving through. You pay per landing now on tires for airplanes, right? So it's going through on healthcare equipment. So the biggest move in healthcare equipment is to pay per treatment, if you will, because a doctor gets that as a much more efficient delivery model. So it's going across multiple industries. And this is only the first step. How many people are familiar with the book B for B? Just out of curiosity. Not a lot. I would encourage people to look up B for B, put out by J.B. Wood. The precursor to it was a book called Consumption Economics. It's actually a good read. But pay for use is simply a step along the way to pay for outcomes. Ultimately, customers want to pay for outcomes. And that is, they want to pay for the value derived. And so where we are today is only a step to where we need to go. If you think about Salesforce.com, do you really want to pay per user per month? Why wouldn't you want to pay per active user per month, right? Some people are on vacation, right? Europeans don't work as many days as US. Why should I pay for people who aren't using the software, right? It doesn't make any sense at all, especially if I have a reduction in force and I've got this 3 years of backlog that I have to commit to. It doesn't make any sense. So that will change because CIOs are going to say, I don't want shelfware as a service. But why do you pay to use, right? It sounds like, okay, the software guys are going to take all the hit, right? SaaS companies, it's just a race to the bottom, and it's all this, kind of lower end stuff. And that's not true. If you think about what pay to use does is it opens new markets. It's not about trying to cannibalize your existing market. It's about opening new markets. So we talked about occasional users. Rather than, it's too expensive for per user per month for everybody. What about the occasional users? What about seasonal users? What about financially constrained individuals? So what's an example of financially constrained? Great example would be Salesforce.com. When they came out, it was not for the enterprise. It was for the SMB who couldn't afford Siebel. Right? That's who it was for. And if you think about Amazon Web Services, it wasn't for the enterprise. It was for the startups that couldn't afford their own data center. Car2Go is not for the people who can afford a third car or a second car. It's for the people who can't. Right? It's all of these incremental use cases and opening of new markets. And that's really what software as a service or any of us in the industry need to think about is how are we expanding market opportunity for ourselves as opposed to going in and cannibalizing the rest. And there's a real attraction behind subscriptions, right? So here's the good news. Like you get this initial sale and you get the renewals over time, so customer lifetime value looks really great. And from a business model, that can appear attractive. The challenge is this. Customer acquisition rate over time goes down. I'll give you a great example. The Sales Cloud for Salesforce. Not the same acquisition rate it used to be, right? It just tails down. And it happens in every one of the markets you go into. And so you get this flattening of your recurring revenue over time, right? So you combine downward rates with any retention issues, and you're going to get a kind of fairly flat model. And that's exactly the challenge that subscriptions face. So the only way you can really get long-term growth is you have to figure out how to maximize customer lifetime value. The only way you get long-term growth is maximizing customer lifetime value. And I can prove that just looking, again, at Salesforce. They're a great example because they're ahead of a lot of companies. They're further down this life cycle and trying to figure it out. Why did they buy the Service Cloud? They needed to drive more revenue from their existing customers. Why did they buy the Marketing Cloud? Right? Needed to drive more revenue with their existing customers. They're trying to figure out how do I grow wallet share with their existing customers, not just focus on customer acquisition. So that gets us back to these 4 metrics, right? So we're now in a business that is all about pay for use. It's no longer about pay to own. It's all about pay for use. And it's also all about maximizing customer lifetime value. Not as a startup. First couple of years, go out, kill it, run, get as many customers as you can. You need them. But over time, you're going to have to figure out how to grow the value of that customer base. The second we'll talk about is retention rate. And retention rate, as it pertains, it's the standard thing, nobody wants churn. But why is retention rate so important, especially to valuation of your company and also long-term sustainable growth? We'll hit that. And then revenue acquisition cost. Everyone talks about CAC, customer acquisition cost, right? Well, what about revenue acquisition cost? Because you can get revenue other ways than new customers. And then finally, the gross margin equation, which is critical. So customer lifetime value, why you care about that is your average customer lifetime value can help you understand what your addressable market's going to be. And if you don't have a vision for what is your footprint and your wallet share and your capability inside the customer beyond that initial sale, then you're going to have a hard time creating sustainable growth for your shareholders, for your employees, and creating sustainable and growing value for your customers. You've got to think past that first step. You've got to think about what value, what offerings, what capabilities can I drive, and what kinds of new use cases. So if you look here, it's, first step is, how do I drive adoption? How do I ensure they're getting great value? That'll get me to the renewal. If I do the renewal right and I keep growing adoption, I can actually sell more value into the customer with an upsell. And ultimately, that might lead to then similar products or services that I could do as a cross-sell. And if you're smart, and this is what the sophisticated subscription companies are starting to do, then you figure out how to capture latent demand through usage charges. Again, even within an organization, there's occasional users, seasonal users, certain peak times that they'd like to be able to do. And are you sophisticated enough to deliver that value for your customers in that packaging? So you can read the equation if you want. I'm not going to go through it, and I won't debug it for you. We have an article. So one of the things that Scout has at research.scoutanalytics.com, we essentially study business models. So we have over 100 customers that we're analyzing all their subscription data and all their usage and comparing that to each other. And we run models and we publish research on that. So you can go there. There's an article that describes this calculation in particular. What this calculation does is it can take your just general operating metrics, things like customer acquisition cost, retention, et cetera, plug it into an equation, and it will spit out the answer as to what is your average time to customer break even, right? When will you generate profit from that customer relationship? The average across the industry, if you take industry benchmarks on churn, let's just call it 10% as an average. Some people have lower, some people have higher, right? And you look at gross margin and everything else and you throw it in there. The average for the software as a service industry is about 3.1 years, right, to break even. And it visually breaks down this way, right? So you can see it sort of broken down by these components. You can see where the costs are going, et cetera. But if you think about that, a lot of people say, hey, look, I got a 3-year upfront deal. It's still not profitable on average, right? Even a 3-year upfront is not profitable on average. So that gets you to think about, from a profitability standpoint, first of all, retention rate matters, right? If you think about how SaaS companies have been pounded in the stock market today, it's because of profitability. And if you don't figure out how to generate profits and do it in a shorter period of time, then you're going to have a challenge with your business model. Not only do you want it in a shorter period of time, but you also want to make sure that the customer lifetime is extended, that retention rate is very high. So that's the key to profits. All profits come after the initial sale. So that upfront sale is actually costing you money. You're now at risk of losing money if you don't retain that customer for the appropriate amount of time. Revenue acquisition costs, right? So this really drives your revenue capacity. So it's kind of famously known that it's 6 to 7 times cheaper to sell to your existing customer than to acquire a new one. And that dynamic, again, I won't go through the whole chart here, but this is an example of using customer success data to better know at what point to engage a customer for cross-sell is the right time. And you can get that pretty dialed in and start to drive your revenue much more effectively than, for instance, blanket campaigns to your existing customers. Much more effectively than trying to go out and acquire net new customers. And again, customer acquisition is important, but also thinking about revenue acquisition and that customer lifetime value. What are all the right points at which that customer is ready for a new offer and ready to create more value? And finally, as we talked about, there's this notion of gross margin. In gross margin, this is an example where the ability for automation to come in. I know we just heard the previous panelists to say, you got to be careful on that, which is absolutely true. But I'll tell you, as a user of a marketing automation system, what I really want is self-service. I just want it to work. I want it to be easy to use. I want my teams to be productive. And I don't need a lot of phone calls, right, to check in and do all of those things. I just need the product to do what it's supposed to do. And that's what's most important. So if there's things that are able to keep me informed, to check in, to help me do that, I want that self-service. And I want that ability to say, this product works when I need it, and I actually don't need help. And that's a huge advantage. So these are studies where, again, we were looking at, if you have an initiative, so a customer success initiative, that really is about self-service to the customer, that you have an ability for them to get a better experience by doing something for themselves, and it reduces your gross margin because you don't have to worry about that delivery. And at the same time, it increases your retention rate because their satisfaction goes up. This just shows on a $50 million business, if you do that correctly, you can get $1 million of lift, essentially, that you can go out and decide how you want to invest against your competition. And that's what's important about thinking through things like customer success initiatives, operations initiatives. What do your operations look like? Asset utilization, right? So as you look at it, those all become competitive advantages if you know how to do that right. And if you do it well, you'll actually increase your retention rates, again, while cutting your overall gross margin. So the question probably is, how do you get there? The answer would be, my flip answer would be, obviously, Scout gets you there. But going back to this question about customers buying use. That's what they're buying. They're buying a period of time. They're buying an outcome, ideally in their minds. But they're buying usage. And so getting usage data and leveraging usage data as a part of the customer lifecycle is critical. So obviously before sale, if you're doing a freemium or a trial, you can certainly understand who's most likely to convert, how should you engage with them, do they need help, all of those questions. After initial sale, the question is, what is the time to value? At what point are they up and operational, and what is that time? And is it meeting expectations? Is adoption, right, actually meeting expectation? Are they starting to drive value out of the system? And if not, how do you intervene early on to get that back on track? Obviously, at renewals time, it's a question of did they get value? And at the renewals time, there's a lot of questions that can happen. So first of all, do you really need somebody involved with that renewal? I actually don't want my marketing automation sales rep to call me about the renewal. I'd prefer not to. I'd rather just take care of it because it's nice and all, but I just know that we're going through a dance, and I'd rather just have that done. Now, there's other times that it's pretty critical to call for a renewal. So as an example, if up front, maybe I had really negotiated an awesome discount. Like I said, hey, I'm not going to use this. Really, it's just for a couple of campaigns I'm doing. I really can't afford this marketing automation system. Please don't charge me. So they give me some 70% discount. And by the way, that's actually what happened in one of the situations. So I got this great discount, but I'm using it a lot more than what was expected. That's probably a time to get on the phone and have a conversation about kind of recapturing some of that discount, right, and making that change. But you have to understand whether or not they got value. You can't have that conversation without understanding the value piece. So understanding when should you do things like automation, again, to lower your cost of revenue, focus people on where there's upsells and cross-sell opportunities, all of that becomes critical. The upsells, again, as we just talked about, a number of different ways you can do that. Cross-sells get important for figuring out, based on configuration settings, based on what they're doing, where can you actually drive the next best offer for them? And one example is they change states they're doing business in. So maybe you want to sell a different accounting module to support that, or they're now doing business overseas. So again, configuration settings and things like that can be real good triggers as to when you should intervene. And then usage charges, it's really looking at your rate plans. What is the yield? What's the consumption across your rate plans? And are each of the rate plans monetizing usage the same way? Are some rate plans, quite frankly, under-monetizing? And where should you package and price? If you don't understand the usage, you can't really go in and make those decisions. So that becomes the critical component. If you'd like to learn more about this or some of the topics, so the 4 metrics, we've got an ebook that goes through the 4 metrics, but we talk also about kind of core capabilities that you need, the essential capabilities, and the end-to-end life cycle associated with the customer. So with that, I'll kind of just end with these summary of the 4. So maximizing customer lifetime value is what's going to allow you to maximize your addressable market. Increasing the retention rate is going to be what increases your profitability. And again, a 10% improvement in profits, because they do call it PE ratio for a reason, leads to a nice bump in corporate valuation. Lowering your revenue acquisition cost means you're essentially increasing your revenue capacity. You can sell more. And then optimizing gross margins is what's going to give you competitive advantage to invest in areas that your competition can't. With that, I'll leave it open. We've got 3 minutes if anyone wants to ask a question.
What data do you have in terms of that 90% of the revenue comes from that? How do you see that varying? Is that number from data that you've gotten from your customers or surveys?
So the question was, where did the 90% come from, right, in terms of revenue collected after initial sale? Again, the research alert identifies kind of a more detailed model. But if you think about just traditional on-premises software, you actually collect 60% up front over a 5-year period of time, right? So you get the sale of the software plus first-year maintenance, right? And that's sale plus 20%. So you get 60% of the total value of that customer right up front. That's totally different than I just bought a first-year subscription over a 5-year period of time. There's at least 80%, right, that's now deferred, right? Because if over that same 5-year period, I don't get my other 4 years until further down the road. So there's an example, just a very simple example of where you get to 80% right away. But obviously, that's for a very simple model. That says I'm only selling one thing, and we're going to charge you the same price every year. But of course, you have annual price increases. You end up wanting to do upsell and cross-sell. So very quickly, all of your revenue is coming post-initial sale. Any other questions? Great. Well, thank you. I hope you found it informative.